Good afternoon to everyone. My name is Suresh. So today I will be the moderator for this call. We'll wait another 2-3 minutes to have a session with the Bhavesh. The participants are joining in this call, so we'll wait another 2-3 minutes. Let's start. Yeah. Uh, First of all, good afternoon to all. Welcome to quarterly update on financial opportunity portfolio from ASK. So uh, after the event, I think last 2 days, a lot of discussion on the elections, and after that, lot of clients and lot of fund managers are discussing on which sectors and will be investing for the further. At the same time, the review is also very important. So if you look at today, we have a Mr. Bhavesh Kanani with us, the portfolio manager of ASK Financial Opportunity Portfolio. This call we'll be doing it regularly on a quarterly basis to give an update what's happening on the portfolio and the way forward also. So Bhavesh Kanani have a very rich experience in the financial industry. At the same time, he's been there with the ASK with almost a decade. He has joined with us in 2013. Before this, he has a very rich experience in the other banks and financial services firm with the securities firm. So his main domain is in BFS sector. So he is the completely the portfolio manager of ASK Financial Opportunity Portfolio. He will be giving about his outlook on the portfolio and way forward. Post that, we'll have a Q&A with him. So I request all the participants, request you to put their questions in the chat box. So I'll be taking those questions to Bhavesh and we'll have a Q&A with you. With this, hand over to Bhavesh. Bhavesh, please take.
Thank you, Suresh, for those kind words. Let's straight away dive in. So essentially, I hope the presentation is visible.
Yes.
Let's start with the banks first. In case of banks, when we look at the industry situation at sector level, we had seen a 16% kind of growth, largely driven by retail loans, services segment, and MSME. And here we can see the various sub-segments of the credit opportunity that grew at different growth rates. And service, unsecured, agri, SME were the key drivers for the 16% credit growth. Meanwhile, large industries credit demand continues to remain weak, though there is some improvement in recent months. In terms of entity-wise, we saw IndusInd Bank and Kotak Bank reporting strong growth, well above industry average of 16%. Whereas on the other hand, we had HDFC Bank reporting a weak growth of 12%, largely because post-merger they are focusing more on raising deposits, given that their credit to deposit ratio is one of the highest in the industry, and they need to bring it down over time. From unsecured loan perspective, which has been a focus area for Reserve Bank of India, they have announced certain measures to ensure that unsecured loan growth is kind of controlled over time. And in response to those measures and commentary from RBI, most banks have moderated the growth in personal loan, credit card, and microfinance segments of the loan book, which all put together form the unsecured loan category. So the growth in this unsecured category for all the banks has come down in comparison to what it was in the previous quarter. On deposit front, at system level itself, the deposit growth is at 13% and continues to be below the credit growth. 13% is deposit growth, whereas credit growth was about 16%. Only a handful of banks, Kotak Bank, ICICI, and HDFC Bank, have reported growth higher than the industry average of 13. And because of tight liquidity situation, deposit growth trailing the credit growth, there has been a lot of aggression when it comes to term deposit pricing. And a lot of money is moving from current account and saving account into term deposits. And as a result, CASA deposit growth has been weak. And resultantly, CASA ratio for the entire system has been coming off since many quarters now. From CASA market share perspective, there were only two outliers or gainers, that is HDFC Bank and ICICI Bank, who have been able to gain market share among the larger banks. In terms of interest rate environment, as I was alluding, the banking system liquidity status remains in deficit mode, except for a small period in first fortnight of April when we had seen a little bit of surplus. And because of tight liquidity situation, the call money rates continue to hover very close to the repo rate and MSF rate. Uh, Given that there is widespread expectation of rate cycle peaking out and rate cut cycle beginning, most of the banks are focusing on raising short-term deposits through CDs. As we can see in this exhibit, there has been a tremendous rise in amount of CDs being issued by these financial institutions. And given the tight liquidity situation, as I was mentioning, there is a lot of irrationality in deposit price. On one hand, we have term deposit rate hovering in this 7 to 7.5% range for the leading banks. There are smaller banks who are offering similar kind of rates on saving accounts. And as a result, we have seen the cost of fund rising for most of the banks. And in terms of impact on NIMs, for most of the banks, we have seen NIM contraction on sequential basis, that is compared to the previous quarter. Meanwhile, HDFC Bank maintained a flat NIM, whereas Bank of Baroda and SBI saw NIM expansion. I must highlight here that the pace at which NIM has been coming down has moderated a bit, as large part of the repricing of deposits and other liabilities has happened. And meanwhile, the lending rates remain where they have been in recent quarters. So that is on the core revenue front. Essentially, the net interest income growth was shade lower than the loan growth, whereas there was a lot of support from treasury gains this time around because of the way the yields, government securities yield moved. So in comparison to a healthy revenue growth, the operating expenses growth was higher, Here we can see the growth trends for each individual entities, and we can see that in almost all the cases except for SBI and ICICI, we have seen operating expenses growth higher than that of revenue growth. And what that translates into for cost to asset ratio is, sequentially, it has been higher for SGFC and Bank of Baroda, whereas for most other banks, it has been flattish, except for ICICI, where we saw marginal improvement. Another important aspect, asset quality. For most of the banks, we have seen gross slippages remaining largely stable. Gross slippages are nothing but new NPAs coming during the quarter. There was marginal uptick for Bank of Baroda and Kotak Bank. In comparison to the new NPAs coming into the books, we have also seen a decent amount of upgrades and recoveries from past NPAs. Though as low-hanging fruits or past NPAs are recovered and settled, there has been some bit of moderation in the extent of recoveries each bank has been able to report. From GNPA or restructured assets perspective, as we can see, for most of the banks, there has only been improvement, with the highest improvement being reported by IndusInd Bank and HDFC Bank. And provision coverage for most of the banks continue to remain above 70%. So they are comfortably covered. All the NPAs on the book are decently covered in terms of their potential impact on P&L. The sum and substance of all these financial numbers is the return on assets and return on equity. As far as ROE is concerned, we saw marginal improvement across most leading banks, with ICICI Bank reporting the highest improvement. In terms of ROE as well, we have seen expansion for almost every bank except for Axis Bank and HDFC Bank. Another important segment, NBFCs. Robust growth continued across various types of NBFCs, whether it is vehicle finance companies, affordable housing finance companies, or other miscellaneous kind of NBFCs. Some of them we own and some of them we track. In comparison, the NII growth was a little lower because of the NIM expansion on Y-on-Y basis, more or less similar trends compared to what we have seen for banks. In terms of how this NII growth has translated into bottom line growth, because of NIM pressure, the NII growth was shade lower than AUM growth, almost in all cases. And in terms of PAT growth, it was further lower than NII growth in many cases, whereas it was higher than NII growth or pre-provisioning profit growth in many cases. So in case of vehicle finance companies, we have seen that in case of, let's say, Cholamandalam, we have seen provisioning normalizing, and as a result, they did report a 24% kind of healthy bottom line growth, but it was a shade lower than what the pre-provisioning profit growth was. In case of Sundaram Finance, the 60% year-on-year growth includes the extra dividend they received from subsidiaries, whereas in case of affordable housing finance companies, the bottom line growth as well as PPP growth continues to remain very robust. And for other NBFCs too, the bottom line growth was quite impressive, other than the one entity, that is SBI Cards. In case of REC, we have seen negative provisions, that is on net basis, there was a provision write back due to recovery from old return of NPAs. And as a result, the bottom line growth was higher than the pre-provisioning profit growth. On life insurance front, the retail APE growth for the sector was modest, largely because there is a high base impact of the last year, when we had seen a lot of pent-up selling of non-par products in March 23 quarter because of the tax rate changes above certain threshold level in terms of premium. Entity-wise, iPro as well as SBI Life reported healthy growth, and because of exceptionally high base in retail AP, HDFC Life has seen a marginal kind of decline. In terms of product mix, since the tax rate changes, we have seen life insurance companies focusing on ULIPs incrementally, and ULIPs being a low margin product, we have seen VNB margin coming under pressure more sharply for ICICI Prudential compared to others. But other entities, that is HDFC Life and SBI Life, too have witnessed some bit of pressure during Q4 on VNB margins. On non-lending financials, AMCs and RTAs have had a very solid quarter because of strong quarter for equities, which led to a impressive growth on AUM front. For AMCs, as the size of their schemes increased, they have to lower yields because of the telescopic pricing on TER laid down by SEBI. And as a result, the revenue growth was a shade lower than what the AUM growth was. However, because of operating leverage and strong other income, we saw bottom line growth, which was in most cases higher than the AUM growth. For exchanges, let's say for MCX and BSE, we have seen the premium cash and future ADTO registering a very strong growth for BSE. And in terms of premium ADTO, we have seen strong growth for MCX. All this has translated to very strong growth on revenues and even higher growth in bottom line because of sharp increase in volume for both of them. At an aggregate level, the portfolio companies in this scheme generated a sales growth of around 29%. This compares with 7% growth seen for Nifty 50. And more or less similar kind of growth we have seen for operating profit as well as bottom line, significantly outpacing the growth on the same parameters for Nifty 50 companies at an aggregate level. This is the distribution of how the portfolio is structured in terms of various sectors. And in terms of macro backdrop and how we are looking at the current situation, interest rate cycle continues to get pushed because of various factors. Inflation is not coming down within the corridor, set down by RBI. However, markets have been quite resilient. We have had many hiccups in form of geopolitical worries, fluctuations in commodity prices, and increased freight cost globally and impacting many sectors. And despite that, markets have been quite resilient. The most recent major event being the election outcome. While the outcome has not been as per liking or as per market expectations, we have seen strong volatility in last few days. But the fact that the ruling party is going to continue to remain in power at the center lends credibility to the various policies they had set in motion. In terms of data points, GDP growth continues to remain very strong. And the other important aspects like current account and fiscal deficit continue to remain in control. On corporate performance front, FY24 was a very strong year with overall Nifty earnings growing by 26%. After creating this strong base, we expect earnings growth to be healthy but relatively lower in 14 to 15% range for next 2 years. With that, I end my end of the discourse, and we can open the floor for Q&A.
Thank you, Bhavesh. The giving me what actually happened in the portfolio and how is it. Uh, Participants, I request you all the people whoever have any questions, whatever the things, you can just type in the chat box. So according that, we can take it to Bhavesh. Bhavesh, before some of the questions is coming, uh, would I think as a quarter has gone, at the same time, the event is over. Can you just give us the brief in the last quarter? What are the are in terms of the last 6 months? What are the changes you have done in the portfolio, and why those things? So that will help us in terms of the actions what happened in the portfolio.
Sure. So, like we discussed in the last quarter discussion as well, that incrementally as the interest rate cycle turns, and we may see rate cuts happening in second half of the current calendar year, that is likely to add to NIM pressures for lenders who are having more and more of floating rate loans, especially linked to repo rate. So, because of this anticipated likely rate cuts and its implications for profits of many of these banks, we have been focusing more on the non-lending side, wherein last many months we have added Bombay Stock Exchange, we've added CDSL. All these businesses are not linked with the credit part of the opportunity and rather focusing on the savings or capital market opportunity. And naturally, as a result, they are unlikely to be impacted by the interest rate cycle. So that is a gradual shift we are trying to make. We'll continue to focus our efforts on making more and more these shifts and try to prepare for the change in interest rate cycle.
Understood. So basically, from lending business to non-lending businesses, which have been the case for the last. Understood.
Certainly.
Uh, the as the event is over, at the same time, as you rightly mentioned, the not on the single largest party, but alliance is coming. So is that is going to be a some more changes you are expecting the portfolio as per the event, or you have been stick to that what actually what you thought in the portfolio actions?
So when it comes to the constituents of FOP and how the market has behaved in recent days, one I would like to put out that immediate knee-jerk reactions of market should not be given the entire importance. What we should do is react to fundamentals and not prices. When we look at fundamentals, uh, within the portfolio companies, some of the companies, let's say State Bank of India, which is a public sector entity, then we have REC and Bank of Baroda. Now, as far as fundamentals of State Bank and Bank of Baroda are concerned, these are large banks with widespread exposure across many sectors. And when it comes to the perceived risk of the market on which sectors may be adversely impacted, market seems to have expressed worry on sectors like defense, on certain areas of infrastructure, let's say power, and to an extent in railway related stocks as well. However, as far as State Bank and Bank of Baroda is concerned, as I mentioned, they have diversified exposure and not really impacted that much from these sectors. If at all, I mean, the perceived risk becomes a reality. More important point is, all these sectors, whether it is railways, defense, infrastructure, power related, these are very important sectors. And the manner in which the previous government had gone about implementing, projects across these sectors is likely to continue because end of the day, although it is a coalition government, the largest component of the coalition remains BJP. And so we do not see significant risk at this stage to the pace at which and the policies which the government was focusing on. These are the areas that will continue to remain important, and past policies, projects, or targets that they've set. Let's say for renewable energy, there are certain targets. The central government was looking at certain share of overall energy consumption reaching to a certain level, and all these are harsh realities. We have to over time increase the share of renewable energy in total electricity production. So it is beyond, beyond, one individual, one particular government versus the other. These are harsh realities, and past government was taking steps to address those challenges, and I think they'll continue to focus on them.
Thanks, Bhavesh. That's helped the in terms of the event and changes. So one common question which is coming from our investors, the interest rate cut, the major economy of the US. I think we've been hearing about the rate cuts from about the last 6 months. I think it was discussing from last November onwards. As you rightly mentioned, it may happen in the second half of this financial year. So currently, the Canada has also started interest rate cut, or that hinting that. So, what is exactly the view on the interest rate cut, and if it happens, or if it delays in both the situations, how it is impact on the FOP portfolio?
So, situation in US and domestic in terms of the underlying trends for interest rate cycle are kind of similar in the sense that while inflation is coming off, it has not come down sufficiently enough for rates to reverse. Domestically, the overall demand remains quite strong, as we have seen in case of GDP growth as well. And once inflation comes back into the corridor that RBI has laid down, probably RBI will consider easing the liquidity situation and probably also consider cutting down policy rates at some time. Uh, you are right that there have been expectation of rate cuts since many months now, but those expectations have not translated into reality, and the timelines of potential rate cuts have only been pushed further into future. At this stage, it seems that potentially we may see some bit of rate cuts in second half of FY25. Now, when rates are lowered, uh, for lenders, how it impacts is today for most of the banks, 40 to 55% of their loans are linked with repo rate. And whenever repo rate is lowered, banks will have to pass on that benefit to end borrower. So you will find that most of the housing loans are linked with repo. Now, when bank passes on the benefit to borrower, their own cost of fund doesn't come down as soon as repo is lowered. Their cost of fund comes down gradually because if on day one banks lower term deposit rates, only the new term deposit will come at lower rate, but the old term deposits will continue to earn higher rates which were existing earlier. As a result, in the interim period, what happens is your interest rate charge on loans comes down, whereas your cost of fund comes down but slowly, thereby creating pressure on the net interest margin, which is what I have been highlighting in our past discussion, that this is the phase for which we are preparing by increasing the salience of non-lending businesses. However, it is not a situation where all the lenders will suffer. Let's say in case of NBFCs, there are a lot of NBFCs or segments. Let's say in case of vehicle finance segment, their rates do not come down with repo rate. Let's say if you take a car loan or a commercial vehicle loan, the rate for such loans are fixed for the entire tenure of the loan. So their ability to protect NIMs because of fixed rate nature of the loan product as well as pricing power allows a lot of NBFCs to protect their NIMs or to limit the contraction in net interest margin as compared to banks. So we have been dwelling on this entire set of possibilities, and wherever possible we have been making those changes to ensure that the impact is minimal. Also, it is important to note that the pace at which rate cuts happen also has an implication. If the rate cuts happen rapidly, the impact will negative impact will be more. If the rate cuts are slower, it allows banks to readjust their loan mix and also the cost of funds to gradually come down and thus limiting the pressure on NIMs. So our sense is the rate cuts this year, there is a chance that we may see first of rate cuts in this calendar year, and it will come down only gradually in all things considered, and that is the outlook on interest rate.
Excellent. Thanks, Bhavesh. That will help more. Bhavesh, in the portfolio, uh, we have seen that lending businesses as well as the non-lending businesses, but in the exchange as well as the AMC businesses. So we don't have any the AMC business in the portfolio, but those businesses have done very well in the stock price point of view in the last 1 2 years. So did
True.
we miss that bucket, or uh, are you planning to add? You're seeing the profit growth, but not the revenue growth as like in the top line growth, which has happened. So why did we not taken, and what is the things which the customers would like to know on the AMC business?
Sure. Certainly, they have done amazingly well, both in terms of revenue growth as well as AUM growth. The only reason we hesitated from participating in the story was, SEBI's desire to revisit the entire structure of total expense ratio, that is TER. In fact, they had, kind of released a draft regulation note, which, if implemented, would have created a lot of pressure for the profitability of asset management companies, because there were many significant changes SEBI had proposed. Uh, After proposing the draft, we had also seen a lot of pressure in case of AMCs around the time. Uh, Subsequently, SEBI had put the draft regulation on hold after and they had promised that they'll come out with a revised draft. Now, as investors, that left us in a hanging situation where we were not too sure about what kind of changes that can eventually be implemented in form of revised draft guidelines. And that uncertainty essentially kept us away from participating in some of these asset management companies. However, when it comes to the saving story or non-lending financials, we found opportune time or opportune situation by participating the same story through MCX and more recently through BAC and CDSL. Are we considering asset management companies in future? That always remains a possibility. We will take a right call depending on what kind of growth trajectory is likely, how AUM mix is likely to behave in terms of equity and non-equity, as well as giving due importance to the valuations they all are trading at. And the same is true for wealth managers as well. So we really like the saving story, but we also want to make sure that a good story also translates into good returns for us.
Excellent. A lot of questions are coming on the performance. Before going to that, there are a couple of things I just would like to combine. The how the valuations are looking for the FOP portfolio, the versus of the VFS segment. Are we currently, as the earnings has come, or we have been correctly priced our FOP portfolio, which just they would like to understand about the valuations of the portfolio on the long term as well, the current levels.
Sure. So there are extremes when it comes to valuation in the financial services space, right? When we look at banks compared to historical multiples, both all the banks are trading at lower levels. We have seen HDFC Bank, we have seen Kotak Bank, Axis Bank, so on and so forth. So in most private sector banks, the valuations are lower than the past peaks. And that is essentially because, the earnings growth trajectory has been pretty strong, but same has not translated into proportionate increase in stock prices, and as a result, multiples have come down. In case of PSU banks, like your State Bank of India and Bank of Baroda, versus recent years, valuations have expanded, and they are, that improvement is in line with the improvement in ROE they have seen in couple of years. But when we look at past peaks, here too, valuations are lower than what we have seen in best of the times in past. Also, when we look at the current ROE levels for these individual banks, and then when we look at multiples, in most cases they appear to be fair or little bit lower than fair, because a lot of money has not flown into these banks or NBFCs in recent years, and which is getting reflected in the multiples. So there is a lot of value, in the lending space, but there are operational challenges or financial challenges in terms of interest rate cycle, NPAs gradually normalizing. I'm not for a moment saying that NPAs are going to, jump by huge numbers, but it is just that in last 1 year we have seen best of the asset quality performance, and from that exceptionally low NPAs, there will be some upward normalization. Put together, these factors will mean that the bottom line growth is likely to be a shade lower than balance sheet growth. And hence, probably market is focusing on other areas of the opportunity. It has been doing so in recent months. But valuations are pretty reasonable on the lending side. When it comes to the non-lending space, their valuations are significantly higher. In many cases, there have been fundamental changes in the business. For example, in MCX or Bombay Stock Exchange or CDSL, the multiples are upwards of 30, 35 times in that range. And at the same time, some of the leading asset management companies like HDFC, AMC, and Nippon too would be trading 30 times plus, and which is reflection of how the AUM growth has happened and how bottom line growth has also expanded. So when it comes to lending businesses, the valuation multiples are quite reasonable and lower than the past peak we have seen. And when it comes to non-lending businesses, especially non-insurance, non-lending, there the valuations are reflecting the superior growth experienced by industry as a whole and individual players as well. Meanwhile, life insurance company valuations too are reasonable given the growth challenges they've faced, and on top of that, the margin compression they've seen because they are moving from high margin non-par products to your ULIPs. So, various sectors are at different levels of valuation compared to their historical levels.
Got them. Thank you. In the portfolio, there are two segments. There are stocks, as you mentioned, the exchanges like BSC or CDSL or EC has done a very good job. They're the good picks. They have given the good returns like the last 1 year. They had that some portion of the contribution that. So are we going to stick to that in terms of those ideas? Are we going to trim it? That is the first one. Second, there are some laggards in the portfolio, which despite of the good profits we have seen in the Bajaj Finance in the last 2 years, it has been not reflected in the stock prices. What are you thinking of those lines of the laggards? Are you thinking to reduce it to add into some other businesses? And what was the reason for that of not performing those stocks in that space?
So in last couple of years, I mean, the financial performance or let's say bottom line growth, asset management growth has been very impressive for Bajaj Finance. Quarter after quarter, they have been reporting solid performance. But the same has not translated into price, and one can speculate on the reasons. It could be FIs pulling out money from India. That can be one reason. There are other pockets of investing companies where market seems to be focusing more on, let's say, capital goods or railways or power-related companies, and as a result, we have not seen, financial performance reflecting in prices for some of the names that you mentioned. However, today, if you look at the current situation, I mean, Bajaj can comfortably deliver a 22-23% kind of earnings growth in the near term, right? And it is trading at around similar kind of PE, that is 20 times. And we discuss about Nifty earnings expectation of 14 to 15% earnings growth for next 2 odd years. And Nifty 2 is trading at around 20-21 times. Now, when you look at this equation, and that itself, kind of gives me positivity that Bajaj has ability to deliver higher earnings than Nifty 50, but is trading at the same multiple. So while we have seen erosion in PE for Bajaj Finance, today the PE is very close to the kind of earnings growth we can very reasonably expect. And hopefully, incrementally from here on, the earnings growth should start to reflect in form of price activity as well. However, as you would have noted in past, we have been realizing this dichotomy between financial performance and prices, and accordingly, we have been shifting away weights from Bajaj Twins to other names to have a much more balanced and better aggregate financial performance at portfolio level.
Excellent. So, the final, which is a one question that about the performance of the portfolio. There are customers who have been invested in for 4 to 5 years. There are customers has come in a 3 years thing. So all who have been waited for the 4 years and 5 years, as it has not beaten the benchmark and underperformed with a huge gap. So how you're looking and when can they expect to have a bridge the gap between the performance of the portfolio with the benchmark, and is that uh, what time it's the people have to expect, because the most questions are coming is that how long we need to hold this portfolio for to have the to bridge the gap. So how can the it will help the customers of your view?
Sure, sure. So one is we need to understand what caused that underperformance in last, let's say, 2 odd years, which is the areas where we were invested, while it was delivering on fundamental growth, did not see similar kind of response in terms of prices. Whereas areas where we were not present, especially the PSU pack on bank side, those areas have performed really well, much more than what the financial delivery has been, because there was re-rating for all those stocks. Incrementally, we have made a lot of changes, which we have been discussing in past as well. That is, we have cut down risk from certain pockets like banks and NBFCs. We have moved weight to non-lending financials. Within non-lending financials, now we have high growth areas like exchange businesses as well as RTA name like fintech. So all effort has been towards ensuring that at aggregate level the portfolio continues to generate a bottom line growth of 15% plus. And with time, there may be gaps, but eventually financial performance growth or bottom line growth eventually does get its rewards. There may be some gaps, but it cannot continue to remain disconnected for too long. Our hope and desire is to select companies which add to the growth quotient of the portfolio, where we would be looking to select companies where bottom line growth is 15% plus, with hope that that gets reflected into similar kind of price performance as well. In terms of comparison to benchmark, last year, all these changes that we have made ensured that our gap with benchmark is narrowed down dramatically, and we were successful to a great extent. However, I must highlight that the benchmark used in the portfolio statements that clients would be accessing is Nifty 50 Total Return Index, which is not the correct benchmark for this portfolio. The correct benchmark is BSE Finance. However, because of SEBI regulations, we cannot display BSE Finance as a benchmark in the holding statement you would be referring to. So I would just kind of make a humble request to look at performance in context of BSE Finance as well.
Got it. So, Bhavesh, in the last time you have taken some microfinance companies of Fusion, other, like what is the view on that? Have you done any changes in the portfolio because it's been not doing well in that in our FOP? So they wanted to understand that.
Sure. So we had entered Fusion Microfinance few months back, and as you would be able to see in the current portfolio statement, the weight has been cut down already. This is largely because of some of the pockets of microfinance business reflecting some pain, politically driven pain, especially in states of Haryana and Punjab, where Fusion specifically faced a lot of challenges. It so happened that some political activists promised them safety from loan recoveries, even if they stop repaying the loans. Some of the borrowers kind of got influenced by this political activist, and the repayment behavior deteriorated. While Fusion Microfinance continued to provide for that exposure, the pain is still not gone away. And we thought that eventually, although Fusion Microfinance has kind of stopped in giving incremental loans in the region, but we thought we are better off moving that money to other avenues where we would have more safety and better return potential. That said, we are currently continuing to hold Credit Access Grameen, which is another microfinance company. They are not present in the areas of Haryana and Punjab, and they are one of the leading companies both in terms of size, the kind of manner in which they conduct business, as well as return ratios they've been able to deliver. Their ROEs are around 23% in recent quarters. And given the knee-jerk reaction we have seen in recent days, it is also trading at a reasonable multiple. That said, we will continue to scan the gamut of opportunities available to us, and if needed, whenever there is an opportune time, we would be open to moving money from one subsector to the other if it makes sense from overall portfolio's health perspective.
Understood. Okay. So, one again, the repeatedly one of the questions is coming as after this coalition of the government. So, might be the rather than the development side, there would be some inclination to the welfare side, which might happen. So, it might impact on the lending bucket of the financial institutions. So is that, if it is the correct, how you are going to act on the portfolio is the one of the question customer.
Sure, sure. So yes, we too had very long discussions internally. There is this expectation that given the way electorate has behaved, the current government or the new government which will be sworn in may take some measures to kind of comfort the rural areas or that side of the population, focus more on agriculture or probably social schemes. We should always remember that, when it comes to fiscal prudence, that is managing fiscal deficit, the previous government, or let me put it this way, BJP-led governments in past as well have been very prudent when it comes to fiscal deficit. The philosophy at least reflects that they have not believed in spending too much on free giveaways and subsidies. They have always been cutting down on this free money giveaways, whether it is electricity or keeping the fuel prices low or fertilizer and so on and so forth. So, from that historical perspective alone, one can draw comfort that fiscal prudence will not be kind of forgotten. And it is extremely important to have that fiscal prudence because it has far-reaching implication for inflation, for interest rate cycle, for private sector capex, and so on and so forth. So that comfort we can draw from how historically they have behaved. Secondly, yes, coalition partners will have certain different priorities, but today itself there was this talk about having a common minimum program where there would be kind of agreement from all the coalition partners on at least certain aspects which are let's say are kind of non-negotiable, and hopefully all the important aspects related to driving the economic growth through various policy initiatives and focus on certain sectors, and also taking care of areas like national security through supporting the defense sector. Hopefully, they all form part of the minimum program that all these coalition partners will come to an agreement with. It is still fluid, however, we should not, kind of react to all this speculation. We should wait for the formation of government, how ministries are distributed, and see if there is any change in the stance. At this stage, we do not believe there will be significant deviation from the past policies, but we remain, very watchful on every development happening out there.
Thanks, Bhavesh. The last one, I think a few more minutes to close the session. So one of the customer in the current portfolio, we have a Sundaram as Sundaram Finance as well as MCX had a severe fall, which I was seen in the last 1 month of the portfolio. It could be a world as because of the events. His question is it because of any fundamental change in those businesses, or what is the view on that?
In fact, in both the cases, the fundamentals are looking very strong. If we compare the kind of growth Sundaram Finance has reported versus in past, it is much higher. Over long period, Sundaram used to deliver, around 13 to 15% kind of growth in the loan book. This year, the performance has been far better. Incrementally, Sundaram Finance is focusing beyond your vehicle finance loans. They are focusing on housing finance as well as SME loans. So after many years, the focus on non-CV business has also returned, and this addition of this new growth drivers will continue to support in future as well. We have seen Cholamandalam evolving from CV financier to now they are financing practically every kind of vehicle. They have developed that strength. They have added a lot of new products as well. So diversification of products away from CV, while it also helps the growth engine, it also allows an entity to manage a consistent growth even when, let's say, there is some moderation in the CV cycle. So, within CV, then there are different growth rates and different cycle for used CV, for new CV. It's different for tractor versus, let's say, a two-wheeler. So when we have multiple segments for a lender, they are able to manage a much more consistent growth, and which is what Sundaram seems to be doing. For MCX2, the volume on commodity option side continues to be very healthy. The activity continues to pick up pace. Fundamentally, for the entity, they are past the challenges they had faced on software transition, and now that the payments to the earlier vendors 63 months is behind us, the profitability has improved dramatically. Even today, even after all this growth in commodity derivatives, the commodity options market remains a very small fraction of the equity options market, which only highlights the long runway of growth available for MCX. And MCX is a single player on commodity derivatives at this stage with, practically 98% kind of market share. So it's a single beneficiary of, pickup in commodity option volumes even in future. So fundamentally, both of them continue to deliver sound results, and that's the expectation for future as well.
Thanks, Bhavesh, for your patience to answer all the questions. Uh, uh, Participants, if there are some questions which you are unable to ask or not in a type, you can send a mail to our CE team, ce@askpms.in. So we'll reach out to you to have a call with the Bhavesh, or where we can answer it. We can answer it there itself. First of all, thanks for for participating in this call. Thanks, Bhavesh, for your view and the in-detail explanation of the queries. We will catch up in the next quarterly update with the Bhavesh. Have a great day.
Certainly. Thank you. Thank you all. Good day.